Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. Now this video is going to be a little bit special. We had a few comments in the last couple of videos that I really want to address, and hopefully this video is going to be making a complete overview of our current view on the market, on some of the data that we've been looking at recently and how we view this correction, how we think it's going to resolve itself. A lot of people are panicking here. Many people selling as they see all these risks. I can't tell you the number of people that are worried about inflation, worried about monetary tightening, worried about a flattening yield curve, when these were all developments that were very much present here at the top before the market plummeted 14%. So we're going to talk about that in this video. I hope you guys are going to enjoy this one. If you do not forget to smash that like button as hard as you can. It is really appreciated. Now, without further ado, let's get right into it. I want to first address some of the comments and really the type of comments that we've had in the past couple of videos. A lot of people, you can really feel the tension rising in the comment section on YouTube when the markets are falling. People are disrespectful. People act like they are entitled to me telling them what's going to happen in the market from day to day and be exactly right. Now, I usually try to stay away from making these types of rants, but if you can't give objective feedback, constructive criticism, try to make a friendly environment where other people can feel like they can freely debate, then please do not come back to the channel. So in this video, we're going to go ahead and talk about exactly what our outlook is right here. Recovery, no recovery, crash, no crash. And then I want to show you guys a few very interesting charts that are hopefully going to put all of this into context. Now, what have we been talking about throughout the past couple of months, ever since around February, really? We started to get really bearish here when we had the market breadth really degrade, and you can check out this video here. We talked about the bearish divergence between the price and the RSI. We talked about the bearish divergence between the price and the market breadth. And we talked about the 200-day moving average that hadn't been tested since June, and that it's typical to see during a bull market a retest of the 200-day moving average. And at the time, the 200-day moving average was 10% off the all-time high. In another video, we talked about the Fed tightening fear, and that every time leading up to a rate hike, you get a period of consolidation on the market. And this was right around the time the Federal Reserve was announcing that they were aggressively changing monetary policy. And now we've had a massive 14% correction, and all of a sudden investors are super concerned about inflation, super concerned about the Federal Reserve tightening. They're concerned about a slowing economy, but most of these factors were very much present right here at the all-time high. So what does that mean? That means that a lot of those risk factors have been discounted by the market. It's been priced in. That's why you get a 13% correction in the market. This is the market pricing in the current macro environment. Now, what happens when you get that? You get a lot of fear, a lot of cash on the sidelines. And once that big event that everyone's worried about, so that rate hike, and that's going to be on the 16th of March. Once that's out of the way, what is the market going to look towards? It's going to start to be optimistic. Sentiment can only get better from here. You really have bearish sentiment here. The ratio between the number of bulls versus the number of bears in the market is super low. A lot of people with cash on the sidelines waiting for things to get better. Now, this is our opinion. We do not have a crystal ball. We don't know exactly what's going to happen. That is our outlook on the market. Now, could we get another panic move down, undercut, or retest that low? That is anyone's guess. I'm not here to predict 1 to 2% moves. When you've got the VIX at 35, you have to expect the unexpected. You have to expect lots of big moves in either direction, and there isn't one person that's going to tell you exactly what's going to happen in this type of environment. It's all about risk reward, and it's getting pretty favorable here. Last thing I want to say is regarding the boom and bust cycle. We're just not at that part of the cycle where we can expect a big market top. And I'm going to get back to this point in just a couple of minutes. I want to show you guys a very interesting chart, and that is IWM divided by the S&P 500. So that is the small caps, the Russell 2000 index, divided by the big S&P 500 market. And I actually saw Jeremy from Financial Education briefly talking about this. He was saying over the past month, we've seen small caps outperform the rest of the market, which is not what you typically would see when you're expecting a bear market, right? When small caps perform well, it's actually a good sign that underneath the surface, the market is recovering nicely. And so I wanted to chart that out and show you guys exactly what this all means. I'm going to put this on a 3-day chart so we can see that properly. And we're going to put the S&P 500 on top of this chart and see if we can identify some patterns. And I would say the most important thing to identify on this chart is the fact that bottoms in this ratio, bottoms in the IWM to S&P 500 ratio, coincide with bottoms in the actual market. I'm just going to quickly highlight some of these big bottoms on the ratio. Any kind of bottom on that ratio, any kind of bottom in small caps triggers a bottom on the S&P 500 systematically. All of them coincide with big bottoms on the S&P 500. So he's completely right saying that what we're seeing here, this outperformance of the small caps index relative to the S&P 500 is good. Now, again, it's not a crystal ball, right? Could we see this type of thing? Absolutely. It's all about probabilities, and this is pretty good. It's pretty good news. Now, if you're a member on our website and you're subscribed to our service, you'll know that we expect IWM to outperform significantly over the course of the next few months. S&P 500 recovery, we expect small caps to absolutely skyrocket and recover a lot of the ground they lost here. You can check out the articles that we already posted on small caps on our trading watch lists under the trading tab. And of course, we'll be making more videos and more articles on this as we see developments occur. So this is pretty good news. If we want to apply technical analysis to this chart of IWM against the S&P 500, there is still some work to do. We have this big long-term price channel going back to 2015. You can see it broke down here during COVID, retested, and then once you had the vaccine announcement, it broke back into the channel and rallied to the top. That was the big run we had on small caps. So right now it's retesting this line that it broke. If we pop back into the channel, we can expect a big move higher. Now, I said I would talk about the boom and bust cycle. Now, this is the yield curve. It's a beautiful representation of the boom and bust cycle when you have the yield curve approach the zero line here. That's when you know that you're starting to get towards the end of a cycle. So that's exactly what's happening right now. We are getting towards the end of a cycle. So I know that you guys very much like, clear indications of exactly where we are in the cycle and exactly what type of moves we can expect. Somebody asked me, can you really get a big equity rally when you've got the yield curve flattening like it is now, when you've got the yield curve at just a quarter point away from the zero line? It was a very popular comment, and that is a great question. And so we can go back here over the past couple of cycles and see what we can expect with the yield curve at the current level. And here you can see we had a big correction on the market in 2018 as the yield curve was flattening. We had the market scared of monetary tightening. We had a slowing of the economy, very similar to the conditions we have today. And we had the exact same thing in 2006. Big correction in the market. It doesn't look like much, but this was definitely 10% correction as the yield curve was flattening aggressively and even inverting, and that was followed by a massive rally to the all-time high. The same thing happened here in 2019, a massive rally to the all-time high. And I am probably making some big generalizations here, but I think that we're somewhere in these types of scenarios. We're in the later part of the economic cycle with a very aggressively flattening yield curve, a slowing economy, and a Fed that's beginning to tighten, but you can still get very powerful rallies on the stock market in this type of environment. And that is still our preferred scenario right now. In fact, I've heard many interviews out there saying that returns are going to be very, very low here and that we're just going to be making a sideways period of consolidation. I don't think so. I think the returns from current levels are going to be exceptional. Now, if you measure the returns from the 1st of January, then yeah, okay, the returns aren't going to be that great. But from current levels, we've already seen a 15% correction. I think we could easily see a 15% recovery at the very least. The big market top comes later. It comes when everyone forgets about the weakening economy, about the yield curve, about the Federal Reserve tightening. It comes when sentiment is overly bullish and nobody expects that the bull market can be derailed. And by the way, looking at 2020 here, I'm in the camp that thinks that 2020 here would have been the top of a massive bear market had it not been for COVID. I think COVID actually saved the equity markets from a larger bearish trend because the Federal Reserve was able to step in very, very quickly and very, very aggressively to create another economic boom. I think in any other case, market performance from February 2020 would have been incredibly low looking out multiple years. If you enjoyed this episode, do not forget to smash that like button and of course subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.